Welcome to this lesson on mortgage-backed securities. In this video, you'll learn about one of the most important financial instruments in modern markets, securities that are backed by residential mortgages. These investment products played a significant role in shaping housing finance and continue to be a major component of the fixed-income market. Let's explore how pooled home loans become tradable securities that investors can buy and sell. So, what exactly are mortgage-backed securities, or MBS? Imagine taking hundreds or even thousands of individual home mortgages and bundling them together into one large pool. This pool is then divided into ownership stakes that can be sold to investors. When homeowners make their monthly mortgage payments, including both principal and interest, these payments flow through to the investors who own shares of the MBS essentially. Investors are buying a piece of many mortgages rather than lending directly to a single homeowner. The process of creating MBS follows a straightforward flow. First, banks and mortgage lenders issue individual mortgages to homebuyers who want to purchase property. Next, these individual mortgages are collected and pooled together, often by government-sponsored enterprises or private financial institutions. Finally, securities representing ownership in this mortgage pool are created and sold to investors in the capital markets. This process transforms illiquid individual loans into liquid, tradable securities. There are four key players in the MBS ecosystem. First are the originators, the banks and lenders who create the original mortgage loans for homebuyers. Second are the issuers, entities like Fannie Mae, Freddie Mac, or private institutions that pool the mortgages and create the securities. Third are the investors, including pension funds, insurance companies, and individual investors who buy these securities to receive returns. And fourth are the homeowners themselves, the borrowers who make monthly mortgage payments that ultimately fund the returns to investors. There are two main types of mortgage-backed securities. The first type is called pass-through securities. With these, investors receive a direct share of the mortgage payments in proportion to their ownership stake. Each month, as homeowners make payments, investors receive their proportional share of both principal and interest. The second type is called CMO, or collateralized mortgage obligations. These have a more complex structure with multiple tranches, or layers, each with different risk levels and payment priorities. This allows investors to choose securities that match their risk tolerance and investment goals. Mortgage-backed securities offer several important benefits to investors. First, they provide a steady income stream through regular monthly payments as homeowners pay their mortgages. Second, they offer diversification because each security contains many different mortgages, spreading the risk across numerous borrowers and properties rather than concentrating it in a single loan. Third, MBS are liquid, meaning they can be bought and sold on secondary markets, making it easier for investors to adjust their portfolios compared to holding individual mortgage loans. However, MBS also come with several important risks that investors must understand. Prepayment risk occurs when homeowners refinance or pay off their loans earlier than expected, which can reduce the expected returns for investors. Default risk is the possibility that borrowers will fail to make their payments, potentially leading to losses. Interest rate risk affects MBS values because changing rates influence both the market price of the securities and homeowner prepayment behavior. Finally, credit risk relates to the overall quality of the underlying mortgages, as lower quality loans increase the chance of defaults and losses. Mortgage-backed securities play a crucial role in modern finance by providing liquidity to housing markets. When banks can sell mortgages to investors through MBS, they free up capital to issue more loans to homebuyers. This creates a vital connection between housing markets and capital markets, allowing money to flow efficiently from investors seeking returns to families seeking homes. Understanding MBS helps explain how financial markets support the real economy and why these securities remain so important in the global financial system.
If you like this video, Hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.